And a pleasant good evening to you. This is Owen McCafferty speaking, thanks to the kindness of Professional Fusion, on issues relating to veterinary medicine, dentistry, dermatology, and other of the medical professions in private practice. The issue today relates to Carefree leases, also known as triple net lease, or net lease, or sometimes net leases. Leases are agreements. They are contracts between a lessee, that is the entity that is leasing the property, and a lessor, the entity that has quiet enjoyment of premises and is then leasing those premises to the lessee. So if you want to think of it, the landlord is the lessor, and the person leasing, the tenant, would be the lessee. So most people want something that's simple. So you hear most advisors to people in the medical professions is saying, well, why don't you just have a triple net lease where if you own the real estate, you don't have to worry about it. You just collect your rent check and your practice will pay for all the costs and expenses. A triple net lease is one that is carefree. That is, you as the landlord, as the lessor, don't have to worry about anything. You just collect your payment and pay your interest expense and your principal portions on your debt. So it seems like that's something that is really appealing. Unfortunately, it has its problems. And one problem that I can think of just right off the top of my head is that there's capital items that have to be considered. Capital items are items that have a useful life in excess of a year and therefore have to be put on your depreciation schedules. Well, if you have a triple net lease, and all the costs and expenses have to be borne by the lessee, that means that your practice is going to have a lot of capital items. So your balance sheet is going to show something known as leasehold improvements. The leasehold improvements are improvements where you have quiet enjoyment of premises, where you have right of use. But what happens after that right of use? Well, all the improvements revert to the landlord. You might say, well, gee whiz, that makes sense. That's good. That's logical. Well, what if you want to sell your practice? And you sell your practice, and it's a period of time that the improvement was made. Let's give you an example. I have a 15-year lease. I make the improvement in 5 years. There's 10 years remaining on the lease. The lessee made the improvement. So the lessee has on their balance sheet a leasehold improvement for, let's say, a major capital item. Let's say they put up another building. Well, you might say, well, that's okay. I'll still collect the rent, and the lease will be borne by the practice. Well, if I want to sell a partial interest in my professional practice, let's say to an associate, the associate has a right of use of premises, but at the conclusion of the lease, the associate doesn't have any tangible right. So hard feelings start to pop up. The landlord, who also was the major owner of the real estate and the practice, who sold a partial interest to an associate, gets to take the whole kit and caboodle, and the associate, who purchased in essence a portion of the leasehold improvement, gets nothing. So that causes troubles. It's far better for the lessor, that is the landlord, to make the improvement and then to charge more rent. What's another example? Well, you've heard of the word private equity. The way it works is that the folks in private equity amass a fund, usually from investors, and they take this fund and they loan a portion of the proceeds from this fund to a company that goes out and buys up practices, be they dental practices, veterinary practices, dermatology practices, plastic surgical practices, accounting firms, whatever it is, they go out and they buy them. And when they buy them, they value the asset based upon the worth of the earnings that are capitalized. So you've heard people say, well, I sold my practice based on 10 times EBITDA. In some professions that's low, in other professions that's really high. But let's just say 10 times EBITDA. So the earnings before interest, taxes, depreciation, and amortization in a practice might be $1 million. So if I sell them for $1 million, that's $10 million. So I receive that $10 million, and if I have leasehold improvements, well, that's fine, but the leasehold improvements for that 10 years are centered in the practice entity. And I don't get any additional money for those leasehold improvements. Even though there would be basis, they can still amortize those leasehold improvements, but I don't get any benefit out of it. So it would be better if I, as landlord, made the leasehold improvements. I'm still going to get $10 million, and I own the leasehold improvements and can depreciate them. So you have to look at where you're going and what you're doing and maybe project it out. I know the Carefree lease sure sounds tempting, but there are inadvertent results when you don't take into consideration other people that may be buying into the practice and what the impact is going to be. So, a little caution. You certainly have to talk with your accountant. And it's not just, should I have a triple net lease or not? What you have to do is sit down with your accountant, your CPA, and your attorney and tell them what you intend to do. And then ask appropriate questions on the classic what if basis. And make sure that you understand exactly where you're going. In a lot of instances, it's better that the improvements be made by a development company or a separate unincorporated entity, depends on what you're going to do and how you're going to do it. Sometimes incorporated development companies are better. But we'll go on that in a separate discussion. In fact, I think we already have. But don't always go with the triple net lease. Or if you do the triple net lease after you sell your practice to an aggregator, accumulator, assimilator, or even a partial interest. So with that in mind, and a recommendation that you always secure and seek competent counsel, this is Owen McCafferty saying adieu, and I know I need a haircut.